Hi candidate, welcome to another session of manifested online classes. So in this session, we continue with the topic of earnings per share, and specifically we discuss on what is diluted earnings per share and the computation of the same. So diluted earnings per share, this is the earnings per share which is computed by those companies which have issued potential ordinary shares. So potential ordinary shares are what? These are those securities which will have been issued by the company at the end of the year, or contracts which the company will have entered into and which requires the company to issue ordinary shares in the future. A good example of a potential ordinary share is convertible securities like convertible debentures, or stock options which are granted to the employees and which are to be exercised in the future. Definitely, once these particular potential ordinary shares are converted into ordinary shares of the company, then the interest of the original shareholders will be diluted. And therefore, International Accounting Standard number 33 requires any company having potential ordinary shares to compute diluted earnings per share and disclose that as part of the notes together with the basic earnings per share. So therefore, it is important to note that this diluted earnings per share is only computed by those companies which have the potential ordinary share. So therefore, we can say that DEPS is computed by entities which have potential ordinary shares, e.g. convertible debentures, share or stock option options, etc. So the reason why these companies are required to compute now the diluted earnings per share is because once these potential ordinary shares are converted into ordinary shares, then the interest of the original shareholders will be what? Will be diluted. That's why we are saying is a requirement by IAS 33 for these companies to do what? To compute the diluted earnings per what? Per share. So we can say IAS 33 requires companies or entities having potential ordinary shares, that is abbreviated as POS, potential ordinary shares. IAS 33 requires entities having potential ordinary shares to compute and disclose DEPS together now with the basic earnings per share. So this diluted earnings per share, we said it must be disclosed as part of the note now to the financial statement. So therefore, any company having POS is a requirement. It has to do what? To compute and disclose what we refer as what? The diluted earnings per share. Why? This is because once the POS, the potential ordinary shares, are converted into ordinary shares, the interest of original shareholders will be diluted. Will be diluted. And therefore, by computing now the earnings per share, the diluted earnings per share, what the company will be doing, it will be communicating to the shareholders of the company of the earnings per share, or basically the effect of the earnings per share, the effect on the earnings per share once these potential ordinary shares are converted into ordinary shares. If, for example, a company has issued a convertible debentures, we know that the holder of these particular debentures will convert them into ordinary shares. So once they convert them into ordinary shares, so what will be the implication of that to the earnings per share of the original shareholders? That's why we are saying that these particular companies which have potential ordinary shares is a requirement at the IS 33 for them to compute and disclose what we refer to as the diluted earnings per share, together with what? The basic earnings per what? The basic earnings per share. So how is diluted earnings per share computed? So maybe you can just look on the computation of diluted earnings per share. How do we compute the diluted earnings per share? So in computing this DEPS, we compute it, or basically it's computed on the assumption that the potential ordinary shares of the company were converted into ordinary shares. Basically what that means is that if, for instance, you're given some information, you're told the company has issued convertible debentures, then for you to compute DEPS, you do what? You assume they were converted into ordinary shares during the current year, and now you ascertain the implication, or basically the effect of that conversion of convertible debentures into ordinary shares on the earnings, or basically the profit attributable to ordinary shareholders, and also you ascertain the implication, the effect of that conversion on the weighted average number of ordinary shares. So that is very, very important, that this earnings per share is computed on an assumption that the potential ordinary shares were converted into ordinary shares. So that is maybe the first important point we can say, that DEPS is computed on the assumption that potential ordinary shares were converted into ordinary shares during the current year, And once that particular assumption is made, then I've said that we need to ascertain, or basically an entity will need to ascertain the implication of that. If this convertible, for example, the convertible debentures were converted into ordinary shares, so what would be the implication of that, both to the profit attributable to ordinary shareholders, and also what would be the implication of that to the number of ordinary shares issued by what? By the company. Like, maybe let me just illustrate what I mean by that. Let me illustrate here. We assume that a company, or we are given some information that a company has issued, for example, 8% convertible debentures, debentures having a value of like 5 million shillings, 5 million. So for us to be able to compute now the diluted earnings per share given such information, then what we do is that we assume that these particular convertible debentures were converted into ordinary shares during the current year. If that was the case, then that would have or that will affect the profit attributable to ordinary shareholders, and two, the number of ordinary shares issued by this company will do what? Will reduce. Sorry, will increase, that is. And therefore, what you do once you assume that this particular convertible debentures were converted into ordinary shares, you proceed, you compute two items. One, you determine something called the increase in earnings. And number two, you also determine something called the increase in number of shares. So first of all, when we talk about the increase in number of shares, we are referring to the number of ordinary shares which would have been issued by the company on the assumption that these particular convertible debentures were converted into what? Into ordinary shares during the current year. In terms of how we compute this, is very simple, because what you just do, you use the conversion rate. Use the conversion rate which is provided to you by the examiner, to compute the number of ordinary shares which would have been issued on the assumption that those particular debentures were converted into ordinary shares. Then also determine something called increase in earnings. What is increase in earnings? Increase in earnings, this refers to the amount by which the profit attributable to ordinary shareholders would have increased with on the assumption that these particular debentures were converted into ordinary shares. And if these debentures were converted into ordinary shares, it means that the interest payable on these particular debentures, that interest would not have been paid. In other terms, the company would have saved because that interest would not have been paid. And therefore, the profit attributable to ordinary shareholders would have increased with the interest which was paid by the company during that year, interest paid. And because this particular interest paid is tax allowable, then we take that interest net of tax. So to get the interest net of tax, we multiply that with 1 minus what? Tax rate. So therefore, what we are saying here is that in computing the diluted earnings per share, we assume that the potential ordinary shares were converted into ordinary shares during the current year. Once you make that assumption, then go ahead and determine the amount by which the profit for the current year would have increased with. And number two, you determine the number of ordinary shares issued by the company would have increased with how many shares. And once you determine these two items, then you proceed and automatically compute the diluted earnings per share, of which to compute the DEPS, we take the PATOS, profit attributable to ordinary shareholders, which is used in the computation of basic earnings per share, and then to this you add the increase in earnings. Increase in earnings, I've explained what we mean by that there, and then divide that with 1/0, still used in the computation of basic earnings per share, and then to this you add increase in number of shares, and equally I've explained what we mean by increase in number of shares there. So that is the general formula, or basically the formula which is used in computing the DEPS. In computing what? The DEPS. Now, from there, we proceed and we look on specifically how we deal with the various types of potential ordinary shares in computation of diluted earnings per share. And I want us to start by looking on the treatment of the first type of potential ordinary share, and that is the convertible debentures, or convertible bonds, or even convertible own stock or own notes. So these ones are treated in the same way when computing the diluted earnings per share, because these are types of potential ordinary shares. So if you come across some question and you're told the company had issued convertible debentures, convertible bonds, convertible own stock, the first thing you need to recall is that this is a potential ordinary share. These are financial instruments issued by the company, which require the company to issue ordinary share in what? In the future. For you to compute the diluted earnings per share, you basically assume that this particular convertible securities were converted into ordinary shares during the current year. Once you make that assumption, then you proceed, you compute two items. The increase in earnings. This refers to the amount by which the profit for the current year would have increased with on the assumption they were converted into ordinary shares. And in terms of how we compute this, we take the interest which was paid, or compute the interest which was paid by the company during that year, and then you multiply that interest with 1 minus tax rate. Reason being that this interest is tax allowable. That's why we are getting that interest net of what? Of tax. And then also you compute something called the increase in number of shares. Increase in number of what? Shares. So, and to compute the increase in number of shares here, I've said just use the conversion rate provided. Use conversion rate provided. Use the conversion rate which is provided. But in this case, in computing this particular increase in number of shares, it is also important to note that if these convertible securities issued by the company were outstanding at the start, meaning that these convertible securities had been issued when the year was starting, then we assume that the conversion equally would have taken place from the start of the year. And that means that those shares which would have been issued on conversion, the number of ordinary shares which would have been issued on conversion would have been held for the whole year. For the whole what? Year. So those particular shares, don't weigh them on time basis because they would have been held for the whole year. But if a convertible security was issued in course of the current year, for example, the company issued convertible securities, convertible debentures, maybe 6 months to the end of the year. 6 months to the end of the year. So in that case, we assume if they were converted into ordinary shares, they would have been converted from the date of the issue. Meaning that the number of shares which you are going to get, which would have been issued on conversion, you have to do what? You have to weigh them on time what? Basis. You have to multiply them with the proportion of time they would have been held, because automatically those shares would not have been held for the whole what? Year. They would have been held from the date of conversion, which is the date of the issue, to the end of the year. So that is how first of all we treat the convertible debentures, convertible bonds, convertible loan stock in computing the diluted earnings per share. Number two, we have convertible preference shares, preference shares. So this is still a potential ordinary share. Reason being that these preference shares are convertible, means that the holder of this particular preference shares can convert them into ordinary shares. So equally, if you come across a question, you're told a company had issued convertible preference shares, for the purpose of computing DEPS, you assume those convertible preference shares were converted into ordinary shares during the current year. As a result of that, you proceed equally compute the two items. You compute number one, increase in earnings, of which the increase in earnings here is equal to the preference dividends, paid during that year, preference dividends paid during that year. And then number two, you determine the increase in number of shares. So equally to determine this increase in number of shares, what you do, you equally use the conversion rate. Use the conversion rate provided. Use the conversion rate which is provided. And equally, what I've said here, if the convertible preference shares were issued in course or during the current financial year, you assume the conversion would have taken place from the date of the issue. Basically, what that means that the number of ordinary shares we are going to get as the shares which would have been issued on conversion, what you do, you have to weigh them on time basis. You have to multiply them with the proportion of time the shares would have been held during that year. Then let's proceed and look on how we compute or how we treat the other type of potential ordinary share in computing DEPS, and that is the share or stock options. Share or stock options. So when talk about the share or stock option, we know that this basically a privilege, is a right which is given to the employees of the company to buy the company shares in the future at a price which is below the market price. Equally, in computing the diluted earnings per share, we assume that these stock options or the share options were exercised during the current year. The employees of the company bought the shares of the company during the current year, but at a price below the market price. So therefore, what you do, you equally have to proceed and you determine the two items. Number one, increase in earnings, of which the increase in earnings, as far as these potential ordinary shares are concerned, then increase in earnings is always equal to zero. Reason being that here the employees of the company are just granted an option or a right or a privilege to buy the shares of the company in the future at a price below the market price. As a result of the employees being given that right, they are not entitled to any form of return until the time they buy the shares. So therefore, even if they bought those particular shares of the company during the current year, that action by the employees will not affect the profit attributable to ordinary shareholders, simply because they are not entitled to any form of return. So by exercising that option, the company will not save anything, so the profit attributable to ordinary shareholders will not be affected. It will not increase. That's why we are saying increase in earnings for stock option is always equal to 0. And then number 2, we determine the increase in earnings. Remember, the increase in number of shares, not increase in earnings. Increase in number of shares. This one we have said refers to what? To the ordinary shares, which definitely would have been issued to the employees of the company, assuming they exercise this right, this privilege during the current year. And what we know is that if the employees exercise their option during the current year, then they would have been issued with the shares of the company at a price below the market price. So therefore, what we do here is, number 1, we determine the shares which would have been issued to the employees at full market price. That is the issue at a full market price, assuming they exercise the stock option during the current year. And in terms of how we determine these shares issued at full market price, first of all, we compute the amount which would have been received by the company from the employees, and then divide that with the average MPS, average market price per share. Now, these particular shares, because they are issued at full market price, these shares, we say they are not dilutive. Not dilutive. So not dilutive means that they do not reduce the earnings per share. These are the shares the company issue. The company receive additional resources, receive an amount of money from the employees. That money is invested. By the end of the day, the profit of the company do what? Increase. And equally here, the number of shares increases. So here we are increasing both profit and also the earnings per share, both the profit and the number of shares. So therefore, these shares issued at full market price, they do not reduce the earnings per share. And therefore, these shares here, for the purpose of computing the DEPS, are ignored. So these shares are ignored for the purpose of computing DEPS. We don't consider them. So what we consider is now the other element, number 2. And the other element, number 2, is what? Is the bonus shares. Bonus shares. So the bonus shares, this refers to those particular shares which would have been issued to the employees of the company, assuming they exercise the stock option, the right, during the current year, but free of charge. So how do we compute this? So number 1, we take the total shares which would have been issued to them, assuming they exercise the stock option during the current year, and then deduct the shares which would have been issued to them at full market price. And the shares issued to them at full market price is computed using this formula. So we deduct issue at full market price. Now, these particular shares are the ones which are dilutive, So meaning that these shares reduces the earnings per share, because what happened here, the number of shares issued by the company increases, there is no any increase in profit. So generally, we know in computing the earnings per share, you take the profit attributable to ordinary shareholders divided that with number of ordinary shares. So here we are saying the company is just increasing the number of shares issued, but the profit remains constant. The profit does not change. What is the effect of that to the earnings per share? The earnings per share automatically will reduce. That's why we are saying those shares are dilutive. And therefore, these are the shares which are used in computation of the diluted earnings per share. So therefore, the increase in earnings here, as far as the stock or share option is concerned, we say this is equal to the bonus element or the bonus shares. So those shares which are issued free of charge are the ones which are considered here. And you also have to remember that the bonus shares, how do we compute them? We take the total shares which would have been issued to the employees, assuming they exercise the stock option during the current year, minus the issue at full market price. Full market price. And also it is important for me to mention here that this particular bonus shares, we consider them as dilutive. We don't treat them as shares issued free of charge. Here, for the purpose of computing the diluted earnings per share, we treat them as what? As dilutive number of shares. So meaning that if this particular stock option or the share option was granted to the employees during the current year, then the dilutive number of shares which you get here, which are equal to the bonus shares, those shares will also be weighted on time basis. If the share option was granted to the employees during the current what? During the current year. So that's basically how we deal with the share or the stock option. And then next we have number 4, we have partly paid shares. Partly paid shares. So partly paid shares, these are those shares issued by the company at full market price, but at the end of the year, the shares will not be fully paid. So these particular shares are only considered to be potential ordinary shares if by the time the shares will be fully paid for, the market price per share will have increased. That is the only time we consider them to be potential ordinary shares, and therefore we use them in computing the diluted earnings per share. But if by the time the shareholders will be fully paying for these shares, the market price will not have changed, they are not considered to be potential ordinary shares. So therefore, they are only considered to be potential ordinary shares when or we can say they will only be considered to be potential ordinary shares if by the time the shares will be fully paid for, the shares will be fully paid for, the market price per share will have increased. Market price per share will have what? Will have increased. And therefore, in such a case, what you do is that you compute those particular shares which will be issued free of charge. Because if, for example, the shares were issued to the employees, to the shareholders, or even to the members of the public at a price of like 20 shillings, and maybe at the end of the year, the shareholders will not have fully paid for their shares. Let's assume that those shares which will not be fully paid for at the end of the year are 1 million. So, but now at the time they will be paying for these shares, the market price will have increased to 40. So remember here the shareholders will still pay the price of 20 because the shares were issued to them at a price of 20. But at that time, the moment they are fully paying for their shares, the shares are trading at a price of 40. So meaning that they will pay a price which is less than the market price per share. And basically the concept for share or stock option also applies here. Some of the shares will be deemed to be issued to them at full market price, whereas other shares are deemed to be issued free of charge. So therefore, what you consider here are the shares which will be issued to them free of charge. You consider the bonus elements or the bonus shares. So in the bonus shares, the formula is just the same here. So the total shares which will be paid for, total shares to be paid for minus the shares which will be issued at full market price. So assuming this is the information we are given, the shares now which will not have been paid for are 1 million. So these are the shares now to be paid for by the shareholders, and then to this you less the shares which will be issued to them at full market price, which will be 1 million times the amount they are going to pay per share, and then divide that with what? With 40. So these are the shares which will be issued to them at a full market price. Automatically, that means that the other shares, which I think should be what? Should be 500,000. So these particular shares will be issued to them free of charge. And these are the shares now which we consider in computing the diluted earnings per share. So therefore, as far as the partly paid shares are concerned, it is important to know that these are only considered to be potential ordinary shares if by the time the shares will be fully paid for, the market price would have increased. If that is the case, it means that the shareholders, the existing shareholders or the shareholders issued with those shares, they will pay a price which is less than the market price, and therefore you have to determine how many shares will be issued to them free of charge. And basically what you do, that is what you consider the bonus shares. And automatically here, because this we are saying is equivalent to stock option or share option, the increase in earnings for such shares, shares is always equal to zero, So finally, I want us to look on how we treat the other type of potential ordinary share, and that is the contingently issuable shares, which should be number 5. Contingently issuable shares. So this is something we defined in our first class, or in our first lesson of this particular topic, and we said contingently issuable shares. These are those particular ordinary shares to be issued by the company in the future upon fulfillment of certain conditions. For example, in this case, we said the senior managers of the company can be promised to be issued with the shares either free of charge or at a little consideration upon satisfying certain conditions. And therefore, these particular shares will only be considered to be potential ordinary shares, and therefore used in the computation of basic earnings per share if two criteria have been met. Number one is that the condition agreed between the company and the senior managers, that condition has been met. If the condition was that the senior managers will be issued with the shares either free of charge or at nil consideration once the profit of the company exceed a certain amount, for these shares to be considered as potential, that condition must have been met. The profit must have exceeded that particular amount. And number two, or the other criteria, is that the shares have not been issued. Shares have not been issued. And in most of the cases, because now these particular shares will be issued at a price which is below the market price, we treat these particular shares, contingently issuable shares, as an equivalent of share or stock option. So mean that in computing the diluted earnings per share, we assume that these shares were issued during the current financial year to the, for example, senior managers. As a result of that, you compute the two items, the increase in earnings, which will automatically be zero because we are saying this is equivalent to a share or stock option. Here the shares are issued to the senior managers at a price below the market price. So the increase in earnings is equal to zero. What about the increase in number of shares? Increase in number of shares is also equal to the bonus element. Those particular shares which would have been issued to the senior managers free of charge. The formula for computing the bonus element remains the same as the ones we have discussed here. So the total shares which would have been issued to the senior managers minus the shares which would have been issued to them at full market price. So basically that's how we treat different types of potential ordinary shares in the computation of diluted earnings per share. And those concepts we have discussed here are very, very important because you need to recall them in tackling any question for DEPS. So I want us to stop at that point. Once we come back in our next session, we are going to look on an illustration question which is based on a past paper question.